The S&P 500 is down over 20% so far this year, with its worst first half to the year since 1970. The Dow Jones, another big American index, is down around 15%, and the Nasdaq, another US index which is more focused on tech companies, is down over 29%. But fear not, as Dumbledore puts it best,
happiness can be found even in the darkest of times.
So in today's video, I'm going to cover the probability of you losing money when you invest and the impact of you selling your investments. With all of these headlines flying about the place, it's easy to think that investing is a dark and dangerous place filled with people losing their money left, right, and center. And to be fair, you'd probably be right. If we look at the S&P 500 from 1928 to 2017, there have been over 23,250 trading days. And in over 10,900 of those days, the S&P 500 has been negative, meaning the price has fallen that day. In over 12,300 of those days, the price has risen. That means 47% of individual days the price has fallen, and on 53% it's risen. So basically 50-50. So when you look at investing on a daily basis like this, it completely does look like you're just flipping a coin or betting on red or black in the casino. But let's start to zoom out and take a longer term view. Now let's look at a 1-year timeline, and this is on a rolling month by month basis. So what that means is we look at January 1928 to January 1929, February 1928 to February 1929, and March 1928 to March 1929, and so on and so on. So that gives us actually over 1,000 separate 1-year calculations. And in 277 of those, the S&P 500 fell. It was negative. And in 816, it was positive. That's 25% negative and 75% positive. That means if you had invested in any one of those 1,000 1-year periods, there was a 75% chance the S&P 500 was going to rise during that time. And if we do the same thing for 5 years, those percentages go even further into your favor. 88% positive and 12% negative. 10 years, we're looking at 94% and 6%. And lastly, 20 years, we're looking at 100% positive and 0% negative. That means if you had invested at any point into the S&P 500 from 1928 to 2018, and you held that investment for 20 years, there's not a single time you wouldn't have made money. Pick any month, buy the S&P 500, hold that investment for 20 years, and you would have made money every single time. And this is why everyone says investing is for the long term. Because the longer you hold your investment, the more you're putting the odds into your favor. Now, I also want to cover off another concept about why staying the course when it comes to your investments is so important, especially with all the doomsday predicting flying around at the moment. People can often get worried when it comes to investments and the big red numbers they may be seeing, and they can end up panic selling. Essentially, it wasn't in your goal or timeline to sell your investment right now, but because you're worried about your investments dropping further, you sell them in a panic, essentially trying to time the market because you think it's going to get worse before it obviously gets better. Now, if you're thinking of doing that, I cover exactly why a different investment approach, consistent monthly investments where you don't give about the news and the market and can actually work out 65% better for you than timing the market to perfection in one of my most recent videos, which I'll link up here. But why panic selling can be so bad is because the best returns can often occur at the worst times. By selling your investments to wait until you think it's a good time to get back into the market, you're probably waiting for some good news headlines to start coming out, things to start generally feeling better, but by this time you've often missed some of the best days in the market. And the consequence of missing out on those big days is huge. This graph shows the impact to your account if you were to miss some of the best market days. If you had invested £10,000 into the S&P 500 from the start of 1928 to the end of March 21, you would have $1.09 million. But miss the 5 best days in the market of those 41 years and you'd have 38% less, over $666,000. Miss the 10 best days, you can knock 55% off your million. Best 30 days, take 84% off, and miss the best 50 days, you can take off pretty much all of the growth. You'd have made 93% less. So you've seen 2 reasons why long-term investing, zooming out, thinking of the bigger picture, staying the course and not trying to time the market are winning strategies. But sell out and prepare to miss out. Of course, it's completely natural to feel stressed when you see the market and your account fluctuating up and down, and you want to react. But it's important to understand the potential impacts of your decisions and reactions. And I know the market is looking completely scary and horrible right now, and many investors aren't used to that. The past 10 years have just been a complete 45-degree angle upwards. And of course, that's been great, but times like this are normal, and it's crucial to remember that. As much as I wish they weren't normal, unfortunately, we all have to deal with those ups and downs of the market. And that's what makes it a roller coaster. So remember, zoom out, subscribe, think long term, and invest smarter, not harder, and I'll see you all in the next video.